Hey everyone, Coach Investor back to another dividend video for today and the last for 2023. So 4 stocks I think should be on your watch list or maybe even on your buy list if you're interested in buying dividend paying companies. Now, of course, now that we know that interest rates have peaked, now that we know that we're probably going to get 3 rate cuts already in 2024, love for dividend paying companies, dividend paying stocks should go up as well. As rates go down, love for dividend-paying companies that provide, 3%, 4%, 5%, maybe even more, should go up. Now, of course, some of the companies that we covered on this channel only pay 2.3%, 3%, which is lower than what you get right now on platforms like SoFi, Robinhood, and maybe Schwab or some other platform that you're using. Maybe that's closer to 4.5, 5% or so. But again, as interest rates go lower, that amount should go lower as well, and so money should flow into dividend-paying stocks. Now that said, just because a company is paying today 3% yields, 2.5% yields, does not mean that in the future your payouts won't get bigger. No, usually these companies have increased their payouts by quite a lot in the last couple of years. And that's extremely important when choosing dividend-paying companies. One is, can they continue to pay a nice dividend? 2, how long have they been paying that dividend? 3, have they been increasing their dividend payouts throughout the years? And so in this video, I've chosen a couple of companies in different industries, one that is in the same industry as the other, but you'll see exactly why I chose both of them. All of them pay a nice little dividend yield, and all of them have been increasing their dividend payouts throughout the years. Of course, these are just 4 companies. There are plenty of other companies out there that pay a nice dividend, that are good and growing dividend paying companies. Do mention yours down in the comments below if you hold any dividend stocks in your portfolio. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not. If you want to support me even further, do check out the link down in the description and in the pinned comment to get the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Now let's talk about the first company in this video. It's your favorite expensive coffee making company, among other things, and that's Starbucks. Now Starbucks right now is trading under $100. Currently, before the market opens, it's trading at $98.2. Has a market cap of $111 billion, forward PE of 23.6 times, and has a 2.33% dividend yield. Year to date, it's basically flat. And as you can see, valuation compared to its 5-year mean, PE in the next 12 months, EV to EBITDA, price to sales were all well below the 5-year mean. And even if we look at price to free cash flow, we're here at 30.3 times compared to 33.5 times. So you might say, maybe now is the right time to buy Starbucks. It's a brand that is known worldwide, it's actually loved worldwide as well. Stock has gone down, still pays a nice little dividend, has been growing their dividend payouts as well, as you will see in just a second. And over the past 10 years, you can clearly see that it has been buying back their own shares, making your shares more valuable. Free cash flow per share, of course, we've seen that peak here at around 2018. Since then, it has been a bit flat-ish, but over the next 5 years, the growth rate estimates for earnings per share are at 15.8%, which is pretty respectable. Then if we look at the dividends specifically, you can clearly see here that its annualized growth for the last 10 years has been 17.11%. Basically, if you bought Starbucks stock 10 years ago, you got 13 cents. Right now, you're getting 57 cents. Quite a nice increase. And of course, when you bought, you would probably say, oh, but I could get 5%, 4% with other companies. This one is only paying me 2.3%. Yes, it's true. But as you can see, your shares, your dividend yield that you bought 10 years ago is now much higher than what it is today. And that's the whole thing here with dividend paying companies. Overall, your shareholder yield sits at 2.68%. This is basically dividend yield plus the buyback yield minus the debt paydown yield. So it's a bit higher than the dividend yield. Now, if we look at the analyst expectations, the price target, the average price target sits at $113, which is 15.5% higher than the stock is at today. So yes, you're getting even an upside when you buy the stock here, as well as a nice little dividend payout. Now, why has Starbucks not moved much lately? Well, actually, it was on a 12-day losing streak or so. There was some boycotts, some things with unions, but they here released on December 13 a note. Starbucks reaffirms its commitment to the principles of freedom of association and the right to collective bargaining. There was also third-party data that came out that wasn't that positive for Starbucks, so that signaled a material slowing down for Starbucks traffic and sales in November after the coffee giant delivered strong comparable sales growth of 8% in Q4. Then some additional comments here from JP Morgan. So evidently 85% of Starbucks sales in any given quarter are considered core, and the 15% that is more promotion seasonal in nature can add volatility. Further, we discussed with the company the various impacts related to depleted savings across the lower income consumer, higher credit card, car payments, and return of student loan. This has basically led to JP Morgan to cut its United States Q1 comparable sales outlook to plus 4% from plus 6%. So that was enough to push the stock down back under $100. Overall, they proved in their latest quarterly earnings that the company is still doing quite well and growing, becoming more and more profitable as well. So what do you think? Starbucks, in or out? Let me know down in the comments below. Now moving on to the next company is in a completely different industry. It's actually in the oil industry, and that's Exxon Mobil. Exxon is currently trading at $102, has a market cap of $406 billion, forward PE of just 11.4 times, pays a dividend yield of 3.74%, and is down 4.76% year to date. Here as well, you can clearly see PE EV to EBITDA is lower than its 5-year mean. Price to sales is a bit higher, 1.2 times, but price to free cash flow here, that's in the last 12 months, sits at 10.7 times compared to 22.6 times. So yes, you can clearly see here as well that ExxonMobil looks a bit undervalued. And with that company as well, they've been buying back their own shares. Free cash flow per share has increased quite nicely actually in the last 2 years. But here for the future, for the next 5 years, the estimates here for the growth rate with regards to EPS sits at negative 7.5%. So maybe that's why you're seeing this stock trade at a cheaper valuation than previously. Now, what does the market think? Well, the average price target sits at $126.4, which means the average analyst sees a 24.4% increase in the stock in the next 12 months. Then when looking at the dividend specifically, we can see here 41 years of consecutive annual increases. In the last 10 years, the annualized growth is 4.25%, which means if you bought 10 years ago, you got 63 cents. Right now, you're getting 95 cents. And here, if you want to look at the shareholder yield, sits at 9.2%. So you're getting 3.62% dividend yield, 4.38% buyback yield, and then the debt pay down is 1.16%. So you're getting a much higher yield than just the dividend yield by combining dividend and buybacks. Now, with regards to Exxon specifically, despite what you might think, if you look at the US crude oil field production, it's basically at the same levels we were back in 2020. So yeah, I mean, record levels in the last 10 years. Now, for the next couple of years, things might actually get better for shareholders because ExxonMobil corporate plan more than doubles earnings potential from 2019 to 2027. So that's an 18% compound annual earnings growth, significantly outpaces peers despite what we've seen with the negative 7% EPS. Of course, this is a plan. Remains to be seen if they can execute on that. So they're on track to deliver around $14 billion of further earnings and cash flow growth potential over the next 4 years, which definitely makes this dividend safe and makes buybacks more attractive. Now, they gave us a couple of scenarios here, one with Brent at 50, at 60, and at $80. So this is basically what happens here. In all 3 scenarios, I mean, things look quite okay. Now, I do have to add here the risk, which is something that popped up more recently. If you're not following the news, Venezuela might take over an area in Guyana, which of course Exxon operates in, Chevron operates in as well. And if this becomes another geopolitical issue, this might hurt a company like Exxon Mobil, but not just them, Chevron and other players out there as well. So this is definitely something here to consider. But overall, buying this company right now at this price, to be honest, is a pretty good decision for the long term. It's a company that is still extremely important for a lot, if not all, the industries around the world, despite the transition towards a more sustainable future. Exxon and companies like Exxon are still of extreme importance. So I think they'll do quite well. Up next is another company in the food industry. It's a bit more expensive than the other companies that we've covered in this video, but still a very, very good company to hold for the long term. And that's the Golden Arches. It's McDonald's. So McDonald's is trading at $290. It has a forward PE of 23.7 times, market cap $210 billion. Year to date, it's up 12.5% and pays a 2.3% dividend yield. Now here, as you can see, although PE, EV to EBITDA in the next 12 months is a bit lower than its 5-year mean, it still is a bit expensive. I mean, if you look at price to sales, 7.9 times compared to 7.6 times. Price to free cash flow in the last 12 months, it's pretty close to the 5-year mean. So yes, here the margin of safety is a bit smaller than the other companies that we're covering in this video, but still a very, very good company to hold for the long term. And yes, you guessed it, McDonald's over the last 10 years has also bought back a lot of their own shares. Free cash flow per shares is increasing as well. The EPS estimates with the 5-year growth rate here sits at 9%. Now, this company, you might say, it's in the food industry. How much better can it become? Well, despite what you might think, they actually think that with the help of AI, they can make sure that your fries are fresh each and every time. And to be honest, if they can achieve that, well, I think it deserves a premium. Now, if we look at what the analyst thinks, well, the average price target sits at $314, which means that's an 8.5% increase from what we're at here today. And looking at the dividends, so in the last 10 years, the annualized growth is 7%. If you bought it 10 years ago, you would be getting 81 cents. Currently, you're getting $1.67. Overall, shareholder yield sits at 2.51% because you're getting dividend and buybacks. Now with McDonald's, they announced their future plans here for the next couple of years. So they're targeting 50,000 restaurants by 2027. They're expanding one of the world's largest loyalty program from 150 million to 250 million 90-day active users by 2027. They're also connecting thousands of restaurants worldwide with Google Cloud technology to improve operations and customer and crew experience beginning in 2024. And this might help with the margins here. And more recently, they opened a new type of restaurant called Cosmix. So McDonald's plans to open 10 locations of Cosmix, a new spin-off brand, to test whether the concept could work across the United States and other markets. So Cosmix is a fast, convenient way to grab a pick-me-up snack or coffee. If you go to their website, it really looks, it looks pretty nice, pretty cool, something you would think of when you read the name Cosmix. Here you're getting, well, something pretty similar than what you could get probably at Dutch Bros or Starbucks. So they're definitely competing in that market. Then according to McDonald's CEO, actually, he says that this is a $100 billion category growing faster than the rest of the informal eating out segment and has superior margins. Now, again, just because this is a huge opportunity doesn't mean that this is going to be a successful thing for McDonald's. This is still in the beta testing mode right now. Remains to be seen how that plays out. Now, if you're in the United States and you've tested that out, do let me know in the comments if you like it, if you think this is going to be successful. Let me know down in the comments below. But this again shows that McDonald's, despite being, let's say, a legacy business, is still trying new things. Then up next, company number 4 is a company I own personally in my dividend-paying portfolio, and that's a company in the agriculture industry. You probably already know what that is, and that's Deere & Company, John Deere. If we look at the company right now, it's trading at $392.9, market cap of $111.8 billion, forward PE 13.7 times, year to date it's now 8.5%, with a dividend yield of just 1.51%. Now, more recently, they reported their quarterly earnings. The stock crashed a little bit. So that's why you're seeing that in the last couple of weeks, the metrics here have been a bit lower, but still compared to its 5-year mean, we are lower than that for PE, EV to EBITDA in the next 12 months. Price to sales, we are a bit higher, 2.3 compared to 2.1, but price to free cash flow, we are much lower at 27.1 times compared to 52 times. And here as well, in the last 10 years, Deere & Company have been buying a lot of their own shares. Free cash flow per share has increased quite a lot in the last couple of years. The growth rates, the EPS growth rates estimates for the next 5 years sits at around 8%. Now, it's very important to note that Deere & Company is a cyclical business, which is why we've seen now that the stock has gone down a bit. The company was trading at a premium, let's call it, and outlook was not the best outlook given, which is normal with cyclical companies. You will always get to that point where outlook is a bit lower than what we've got previously. More on that in just a bit. If we look at what the analysts are expecting, the average price target sits at $422, which means it is an 8.73% difference to where we're at today. If we're looking at the dividend, well, they have an annualized growth rate in the last 10 years of 9.76%. Basically, if you bought 10 years ago, you got 51 cents. Now you're getting $1.35. But here you can see that the shareholder yield currently sits at negative 2.58%. Why is that? Dividend yield sits at 1.3%, buyback yield 6.45%, but the debt paydown yield right now is at 10.3%. Now, if we look at their performance in fiscal year 2023, you can clearly see that it was a great year. Net sales and revenue increased 16%, net income increased 43%, diluted earnings per share increased 49%. But if we look at agriculture and turf, the industry outlook in units for fiscal year 2024, here you can see why the sentiment was a bit negative. So US and Canada, large agriculture down 10 to 15%. Small agriculture and turf down 5 to 10%. In Europe, down 10%. South America, down 10%. Asia, down moderately. So here again, you can clearly see the cyclicality. That doesn't mean that this business is suddenly done. It's over. No, just a period like we've seen with the semiconductor industry. It's a period of a slowdown, but then you go and reaccelerate, and that doesn't mean that these businesses didn't operate quite well. No, they became actually more profitable during that period. So that will be it for this video. Those are the 4 companies I wanted to show you in this video. Again, there are plenty of other companies that I can show you in these types of videos, but this time we've got food and beverage, oil, and agriculture. A bit of diversification here. Do share your thoughts down in the comments below. Do share your dividend plays as well. Let me know down in the comments below if you think that dividends will become more popular in 2024. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I see you all in the next one. Bye-bye.